Because of large government deficits, rising debt, and global inflation risk, global long-term government bonds have been sold off sharply as investors demanded higher yield to compensate for the risk I just mentioned. First, let's look at the chart at the right. You see the big economies' government bonds trends. The 10-year and 30-year bond yield are at very high figures now, and zooming into U.S., the 30-year has reached 5.34%. 10-year is trading at around 4.7%. Foreign demand for U.S. Treasury has weakened. Japan, China, and UK reduced Treasury holdings in June. The June foreign holdings of U.S. Treasury fell, but remained 2.3% higher year-on-year. This shows that foreign demand is still large, but recently weakened, and this matters because foreign investors help to finance U.S. government borrowing. The bottom line is, investors are not refusing to lend to the U.S. They're increasingly saying, we'll lend, but only at higher interest rate. For some background, the U.S. government continuously spends more than it collects in revenue, so it must issue new Treasury bonds or debt to cover the difference to continue sustaining. The U.S. federal budget deficit widened 48% year-on-year. That's far above the estimated figure. You can see a slight improvement from May to June, but worsened a lot in July. The debt amount has been piling up. U.S. government debt crossed $40 trillion for the first time. Look at the trend at the right. And interest costs is another problem. Around $1.1 trillion is already spent annually in interest costs. And now that the yields are going higher, refinancing these pool of existing debt will be even more expensive. Furthermore, there's added risks in inflation. U.S. Treasury Secretary Scott Bessent responded by doubling the buybacks of 10-year and 30-year Treasury bonds to at least $4 billion per operation and will continue to do this until the yields are lower. The aim is to support prices because when investors sell, prices drop. With the lower entry point, that means yields go up. So that's why the aim of buying the 10-year and 30-year existing bonds from the market is to reduce the sharp increases in yield. The first round of intervention only produced temporary relief. The 30-year yield fell to 5.18%, but subsequently moved back to 5.25%. It's only slightly lower than the 5.34% before the intervention. So how is the U.S. Treasury doing this? Firstly, they raised money by selling new short-term Treasury bills. And money market funds have been strong buyers of such short-term bills. There's demand for this. So after U.S. Treasury raised the money, they used it to buy back some of those 30-year and 10-year Treasury bonds that investors have been selling. And so again, this act is to support bond prices and push their yield lower. And why does this matter? Rising Treasury yields increase borrowing costs. That also means it'll pressure stock valuations. It'll strengthen U.S. dollar, could be good or bad, depending on different scenarios, and it'll worsen the U.S. government's debt servicing burdens. At the right, you see U.S. debt to GDP has been rising ever since COVID-19. The risk of Treasury buyback is refinancing risk. The 30-year bond, the name states itself, is meant for funding for decades, but the Treasury used the money raised from short-term bills to buy the long-term debt. So if short-term rates rise later, then the U.S. Treasury must refinance those bills at a higher rate. And then future interest cost is also less predictable. Also, the act of buying back doesn't change the deficit. It does nothing to solve the amount of debt that exists. You can see the trend at the right. The interest on U.S. debt has risen so much over the past few years. And lastly, it can confuse the Fed policy. The U.S. Treasury is trying to lower long-term borrowing costs, while the Fed is trying to control inflation, typically by hiking Fed fund rate. The two can contradict each other. The impact on the market is mostly negative. For technology and semiconductor, a higher Treasury yield will reduce valuations. It also makes financing for the big AI infrastructure projects more expensive. And with higher Treasury yield, mortgage rates will also follow higher. That affects home purchases. U.S. mortgage rates has reached about 6.7%. In July, housing starts were down 13.5% year-on-year. Already, you can see the impact in housing. For bonds, companies normally borrow at a risk premium on top of Treasury yield. When companies issue bonds, they'll take the Treasury yield as a baseline benchmark and add a risk premium to compensate investors. So, a higher yield will therefore push the newer corporate borrowing more expensive. And lastly, if U.S. Treasury successfully prevents yield from rising further and pushed it lower, U.S. dollars may need to weaken to attract foreign capital. On to Eurozone. Composite PMI shows business activities are expanding. Manufacturing activities are at the strongest reading in more than 4 years. Services are also continuing the expansion. Overall, the Eurozone economy is showing steady growth despite Middle East conflict, high oil prices, and inflation. The key things are manufacturing strengthened, demand improved, and hence employment starts to improve. Eurozone businesses increased employment for the first time in 2026, particularly in manufacturing area. The Stoxx 600 increased a little. Reuters mentioned that investors were encouraged by a Eurozone economy's resilience. Companies like manufacturing and industrial suppliers are benefiting from the better demand. Banks and financial sectors are benefiting because stronger economic growth supports lending. And the European Central Bank is expected to keep interest rate high. That means the banks and financial sector will benefit from higher interest income as they charge at a higher interest rate for loans. For government bonds, the strong growth and expectations of further interest rate hike will make the older government bonds with lower interest payments less attractive. For currency, euro tends to be positive because of expectations for higher interest rates. On to China. The strong exports and AI-related manufacturing remain as the main support for growth. Other pillars have weakened more than expected, and that makes the recovery increasingly uneven. Industrial output rose at 4.5% year-on-year, but lower than the previous month. Retail sales rose at 0.6% year-on-year, but also lower than the previous month. Fixed asset investments, which includes real estate, dropped 6.7% year-on-year. New home prices dropped 3.2% year-on-year. The background is consumers remain cautious because of weak income confidence and the prolonged property demand. Home prices reduce household wealth. About 52% of household wealth is estimated to be tied to property. And then the previous government incentives like trade-in subsidies are fading. For equities, the weak domestic data will bring economic outlook downwards, but China's strong technology earnings partly offset the concern. CSI 300 rose 1.6% recently and was led by technology shares. For government bonds, there's expectations for easier policy, and so that encourages investors to buy safer government bonds. Currency might be negative because of expectations for easier monetary policy. China recently returned to oil stockpiling after 2 months of drawing inventories. The estimated crude inventory flow turned positive at about 210,000 barrels per day, and it's estimated that China has at least 1.2 billion barrels of strategic and commercial crude inventories, and that gives a large buffer against supply disruptions. China is achieving the stockpiling by restricting fuel exports. July exports remained 12.9% lower year-on-year, and China historically reduced purchases when crude becomes expensive, and then they'll remain buying again when prices fall. It makes sense that they're stockpiling and conserving now. The key takeaway is stockpiling is positive for oil producers, refiners, and tankers, because the country is then relying more on the domestic oil players than importing, but it's potentially negative for fuel-intensive companies like airline and transport. Oil prices rose again on August 21st after Trump threatened sanctions on countries trading with Iran. The earlier U.S.-Iran peace agreement expired during that week, and U.S. is preparing tougher financial penalties against Iran and potentially countries that continue to support trade with Iran. The U.S. naval blockade has also reduced Iran's ability to export crude, particularly to Asian buyers. But the good thing is, U.S. shale production, UAE exports pipelines, and recovering Venezuela supply are helping replace some of the disrupted barrels. Linking today's session to the market, highest on the list is Austria Technologies and System Technique. The recent Eurozone manufacturing business activities are at the strongest reading in more than 4 years. In ATS quarter, one currency adjusted revenue grew 40%. EBITDA jumped 134% because strong demand prompted capacity expansion for high-end AI and high-performance computing equipment. It also has strong long-term customer agreements, including AMD, Next, Valero Energy. The Middle East disruption ultimately pushed refining margins higher. The company's Q2 refining operating earnings more than tripled. And third is advanced microfabrication equipment China. The company is benefiting from China's semiconductor localization push. And giants like Samsung and SK Hynix have evaluated Amex tools as protection against U.S. tight export controls. This structural shift has supported the company in their earnings expectations and hence share price. And lastly, Anglo Gold Ashanti. Because of the Treasury buybacks driving dollar lower, that provided a better entry point for gold, and hence, gold gained about 4%. Anglo Gold's Q2 headline earnings rose 58%, and the average realized gold price increased 35% year-on-year.